Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers, and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they are influential people, and what they say matters a lot because of their experience and background. So, I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully, it will give you a wide and useful perspective. With that out of the way, let me get started. So, the president of Botswana just said something pretty wild about De Beers. They are broke and they are not doing its job. Maybe we should take over and sell them ourselves.
Who is selling? DBS. Then DBS is not doing its job. Maybe we should take over and sell them ourselves. And so before the end of this year, something very drastic in that space will happen. If it doesn't happen, we will die trying.
Now, this is head of a country talking about a company his government literally co-owns. And not just any company, De Beers, the world's largest diamond company. This is, by the way, the same company that once told the world that a diamond is forever. For over a century, De Beers was the diamond cartel, controlling supply, setting prices, and calling the shots. So when Botswana's president announces that De Beers is broke, you pay attention. But at the same time, you might be wondering, what's Botswana got to do with diamonds? Well, this country is the reason De Beers even exist in its current form. Back in late 1960s, Botswana found diamonds, some of the best in the world in fact. When De Beers showed up, Botswana didn't just hand everything over. They negotiated a 50-50 joint venture called Botswana. That's extremely rare. See, De Beers was already this massive cartel controlling most of the world's diamonds. They could have easily bullied a newly independent African country into some terrible deal. That's what usually happens anyway. But Botswana somehow got 50-50. This deal transformed everything. Botswana went from having nothing to becoming one of Africa's fastest growing economies. They actually used the diamond money properly, built schools, roads, hospitals. Meanwhile, De Beers got a stable supply of high quality diamonds. It worked brilliantly for decades. Today, about 70% of De Beers diamonds come from Botswana, as do a good chunk of their profits. If you've been following the space though, this is not surprising. The diamond market is in serious trouble, all because of lab-grown diamonds. They are practically identical to natural diamonds, but they cost a fraction of mined diamonds and can be easily produced endlessly in labs. Their entry effectively turned diamonds from luxury items into commodities. In US and China, the largest diamond markets, people simply aren't buying natural diamonds like before. Instead, the consumption of lab-grown diamonds has skyrocketed. De Beers tried fighting this by launching their own lab-grown brand, Lightbox. It backfired. They triggered a price war and eventually shut it down earlier this year, stuck with a massive $2 billion stockpile of natural diamonds, the biggest since 2008. De Beers even cut its prices, which has never really happened before. Then came another blow. Anglo American, the parent company of De Beers, wanted out. But recently facing pressure from a hostile takeover attempt by BHP, they decided to offload non-core assets, including De Beers. Until recently, it seemed like Botswana was giving the company a lifeline. Just before the current president, Duma Boko, came to power, the previous government signed a new 10-year deal with De Beers. This deal was supposed to be a big win for Botswana. Instead of keeping just 25% of the diamonds from their joint venture, Botswana's share would jump to 30% immediately, then 40% in 5 years and eventually 50%. But does this really matter? See, selling diamonds is hard, especially now considering the biggest seller is facing such a tough time. Botswana is basically getting more diamonds at a time when nobody wants them. When President Boko first came in, he sounded supportive. He talked about needing to safeguard the goose that lays the golden egg, basically saying the De Beers partnership is valuable. Let's protect it. In fact, earlier this year, Al Cook, the chief executive of De Beers, told the Financial Times the Botswana government has expressed an interest to increase its stake in the group. Now that makes sense, considering diamonds are about 90% of Botswana's exports and about a third of their GDP. But as the weeks went by, his tone changed. That's when the president dropped the "they are broke" comment. And honestly, it might be strategic. See, Botswana owns 15% of De Beers and all the diamonds flow through them. Any sale of Anglo's 85% stake basically needs Botswana's blessing. So maybe this is just a leverage, a way of saying you can't sell this without us. There are many more nuances and context to this story, but the format of this show doesn't really allow us to get into that. So I'll be covering this in the daily brief. Please keep an eye out for that. But here's the bottom line. We're watching the potential end of an empire. De Beers controlled diamonds for over a century by controlling the story that diamonds are rare, forever, essential for love. Lab-grown diamonds killed that story. The parent company wants out, and now the country that supplies most of their diamonds is publicly calling them broke. If you have run a business as successful as that of DMart for as long, the brave new world of quick commerce must be confusing nightmare. DMart has always had a core proposition that was custom fit for India. Its customer wanted value. If you could relentlessly chase that as your North Star, you could create a cash machine. Quick commerce flipped the script. It was willing to burn profound amounts of money to deliver customers convenience, often at the cost of value. The bet a company like Zepto took could not have been more different than that of DMart. These new age businesses were willing to bet that customers cared more for convenience. If you could give them things instantly without them having to go anywhere, they would pay a sizable premium. Over the past many quarters, DMart has been smarting over this new thesis. In fact, in one of their earnings call last year, the CEO Neville Narona mentioned that they don't even intend to do quick commerce. And a few months after this, many brokerages downgraded the company, arguing that it was no longer growing as it once did. Quick commerce, it seemed, had eaten into its moat. But is this all hype? Or is there a genuine need for DMart to rethink its business? That's perhaps the big question for the company. In its latest earnings presentation, DMart CEO Neville Narona called the last year one of evaluation and reflection. But the company isn't running on FOMO. If anything, it's certain that there's still room for its business. In Narona's own words,
we are very clear about this, that great respect for what has happened in the quick commerce space, but the country with its size of population, diversity, geographical space, all of that creates also huge opportunity for a brick and mortar business, an efficient brick and mortar business like ours. So we continue to remain very, very bullish on the brick and mortar business.
Outside metro cities, for instance, DMart's value proposition is completely intact.
I can tell you there has been zero impact on non-metros. In fact, we are doing very well in the non-metros. DMart stores in Bombay or Bangalore, are very crowded and very busy because the size of the stores are relatively smaller, all of that. In a small town or a non-metro town, our stores are much larger and infra is much better. And the whole experience, the whole shopping experience of going to a DMart store is actually quite pleasurable. So when you have pleasure and value, it's a solid mode.
That's how you win such a game, the business believes. The smart play, according to DMart, isn't to start burning cash over 10-minute deliveries. That's a race to the bottom. Instead, DMart wants to focus on improving its physical store network and doubling down on its value proposition.
One of the best ways to counter quick commerce is not actually really digital. One of the best ways to counter quick commerce is to have more and more DMart stores. Because from a value proposition, we have an amazing positioning. So for a value customer who's spending 5,000 or 10,000 rupees a month, she or he can really see that they will save significantly more when they come to the store.
How then do they win out? Economics. This is what Narona said.
For all the, discussion around QC, look at the operating cost of the QC. Vis-a-vis, look at the operating cost of value retailer like DMart. So that's the mode, and we believe will exist.
Now, is this true or is it wishful thinking? We can't say for sure, but this is one hell of a battle. Bajaj Finance recently released its first quarter results. In their earnings call, they said some things about their business that made us worried about Indian MSMEs.
We principally track 17 key industries in MSME, out of which 13 that we are seeing are exhibiting signs of slowdown. And 3 actually, so in a way it's all 17, it's other than 1, 3 are actually showing contraction.
See, MSME lending, which makes up roughly 12% of Bajaj's portfolio, has been a concern for Bajaj this quarter. Many of their loans to small enterprises need restructuring or are at the risk of turning bad. One interesting thing we found in their con call is that how much of their MSME loans go mostly to doctors and clinics.
Thankfully, we are reasonably diverse. In that, let me tell you, to the point you asked a rightful question that just go to investor deck. MSME portfolio is 60. Just go to
50,000 crores.
50,000 crores. In that, principally, doctors is 15,000. Doctors is 15,000 crores.
Now, Bajaj has been expecting this. MSMEs in India are falling in profits because our consumers are spending less. So this hasn't come out of the blue. However, it was taken a little by surprise as to when this unfolded.
So it's virtually a perfect storm in a way, and it's come too suddenly. Let me make the third order point, that it's come a little too suddenly.
Most of their MSME loans are unsecured, meaning that these loans were offered to MSMEs without any collateral in return. That makes loan recovery harder for Bajaj Finance. As a result, more of these loans have been classified as Stage 2 and Stage 3, which represent the degrees of risk associated with these loans. The higher the stage, the worse. And their gross non-performing assets have increased from 1.48% to 1.76%. So Bajaj is making its lending standards for MSMEs stricter. And it has offered debt restructuring to certain customers. This would mean making the terms of the loan easier for MSMEs to pay back. This quarter, Bajaj's restructuring efforts were worth 214 crores. Now, this isn't just Bajaj Finance though. As a whole, Indian banks are changing the way they are lending to MSMEs. High-ticket MSME loans have become more common, but the number of loans have fallen. This means that banks aren't just giving money to anyone. Your credit score matters way more than before. It seems like Bajaj is so far on top of this problem and doesn't expect it to deteriorate too badly. However, as we have covered in the daily brief before, our MSMEs are crunched on credit and raw material costs. Their falling business is hurting how much working capital they have to finance daily operations, and that in turn is hurting their ability to get loans. The next quarter will be very important to see if and how this problem worsens. That's it for this episode. If you have any feedback for me, please let me know in the comments below. It's the earning season and Bajaj Finance recently must be a confusing. In US and China, the largest diamond markets, people को मैंने pimply बोला है भाई. In fact, earlier this year, AI Cook, the chief executive of DBR, अरे भाई.
In fact, earlier this year, AI Cook तो नहीं होगा यार, मैं AI Cook क्यों बोल रहा?
In fact, earlier this year, AI Cook, अरे भाई AI Cook.